It's the night of April 18th, 2026. Inside the Strait of Hormuz, where 30% of the world's seaborne oil passes, an emergency is unfolding. Two Indian flagged merchant ships, the Arnav and the Sanmar Herald, report sudden projectile strikes. Both vessels are forced to turn around. Within hours of the strikes, 22 Indian vessels, carrying over 600 seafarers, are paralyzed in the Persian Gulf. News channels immediately lock on the military danger. But quietly, inside the backrooms of South Block in New Delhi, the government is scrambling to contain a different kind of crisis. While physical projectiles pose a danger to the crew, the mechanism capable of shutting down India's global trade is financial, and it is entirely invisible to the public. This illustrates the three mandatory insurance types required for a ship to operate. You need hull coverage for the vessel, cargo coverage for the goods, and war risk coverage against conflict zones. For Indian ship owners, that third pillar, war risk, is a constant vulnerability. Global war risk insurance is a concentrated market, controlled by a few massive underwriters in London, Singapore, and New York. When peace breaks out, rates are manageable. But when missiles fly, markets react by tripling premiums overnight, demanding weeks of documentation or refusing to insure altogether. By the time an owner navigates the new requirements, their charter is gone, the cargo is abandoned, and the voyage is no longer financially viable. The survival of the multi-billion-dollar Indian industry relied on the risk appetite of foreign financiers who owed India nothing. Within 48 hours of those strikes in Hormuz, the response shifted to the highest levels of the Indian government. The Union Cabinet, led by Prime Minister Modi, cleared the formation of the Bharat Maritime Insurance Pool. This pool carries a sovereign guarantee. This means that if damage claims need to be paid, the Indian government stands behind them with its full financial weight. By applying a sovereign guarantee, the government has transformed maritime insurance from a corporate expense into a tool of national defense. This diagram shows the financial scale. The central vault holds a 12,980 crore rupees sovereign backing, providing an underwriting capacity of 950 crores. The pool is built on a 10-year commitment, establishing a structural shift in protecting ships. It provides comprehensive coverage for the physical hull, the cargo, and the volatile war risk category. The eligibility criteria are broad. It protects Indian flagged vessels, Indian controlled vessels, and even foreign flagged ships as long as they are carrying Indian cargo to or from a domestic port. These mechanics create a domestic bypass around London and New York, ensuring Indian trade continues moving regardless of global market volatility. This policy sends a signal to the global shipping market. It demonstrates a new level of logistical independence, ensuring India no longer requires foreign market approval to sail its own goods through contested waters. By providing this backing, India has formally classified its maritime shipping sector as critical national infrastructure, essential to the country's long-term economic autonomy. For an active seafarer working down in the engine room on a vessel today, this policy provides immediate practical benefits. Domestic insurance makes it less likely a ship is cancelled mid-voyage due to lack of cover. This leads to more stable contracts and better job security. For cadets and aspirants, this financial commitment supports the expansion of the Indian flagged fleet, creating a more predictable career path for the next 20 years. The crisis in the Strait of Hormuz forced a decision that now anchors the stability of the Indian Merchant Navy. For more such information, subscribe to this channel. Jai Hind.